Hello, and welcome to The Beat. I'm Ben Honeke, Head of Investment Management at Morgan Stanley. With me is Jim Caron, Chief Investment Officer of the Portfolio Solutions Group. Today, we'll explore how The Beat can help you stay on top of the markets and where we see compelling investment opportunities in 2025. So, Jim, welcome.
Thank you. Thank you for having me.
Maybe before we get started, maybe just give us a history of The Beat, where it came from, and how we want advisors to use it.
Yeah, so look, The Beat in its essence is a thought leadership piece. And the way that we come up with this is we work with all of the thought leaders within Morgan Stanley Investment Management, portfolio managers. We put together what we call an asset allocation committee. We meet quarterly, but we communicate on a more regular basis. We also will invite outside research personnel to come in and give us their thoughts and ideas. And with that, what we try to do is tie our best thinking, our best thoughts, our best ideas with actionable ideas and product. And we do that through an asset allocation framework. Now, why I think this is pretty important, especially today, and how advisors may use this is that, look, as we know, the market has been very narrow in terms of its overall breadth in terms of equities. And one of the things that we've been saying is that it's going to be much more about creating alpha as opposed to just tracking beta. So really, investment selection, asset selection, sectors, styles, all of these things are going to matter a whole lot more in terms of your returns going forward. This is exactly what the Beat is designed to actually discuss and to really delve into. It's to really try to provide that thought leadership into tying together some of our top-down, higher-level macro thinking with actual bottoms-up analysis and valuation, and tying it into product and bringing it into an asset allocation framework.
That's great, Jim. Well, it's a great time of year to have you here. So maybe we'll get into it with all the intellectual content that you have underneath The Beat. So maybe starting with the equity markets, you mentioned the narrowness of it today. Where do you see the equity markets going in 2025?
Yeah, so we're relatively optimistic, right? So we would have the view that equities are, in our estimation, could probably rise somewhere on the order of about 10%, but I don't think it's going to be as linear as many people think. In other words, the way that the equity markets had functioned over the past several years, this narrowness, this magnificent seven, this small set of stocks. I think if you just continue to play the beta and just think about relying on the index, I think you might be disappointed in the years ahead. I think it's really much more about the broader parts of the markets, the mid-cap sectors, the small-cap sectors, large-cap value overall, cyclicals, and even within that, really being very selective in terms of what you're picking, what you're buying, and how you're balancing it overall in your portfolio. So I would say that if you do a good job of diversifying your positioning within and across the equity markets more broadly, you may likely stand to actually outperform the overall index. Now, that in and of itself is a statement. And the reason it is that it's been really hard to beat just the index, right? Because the index has been driven by this very narrow segment of the market. But I think today and going forward, and this is why the Beat is so important and integral to this, is thinking about how you asset allocate and how you pick those sectors is going to matter a whole lot more than just what your target risk weight allocation is to a passive equity index.
And much has been made of the preeminence of the U.S. market versus the rest of the world. So how do you think 2025 shakes out for U.S. versus rest of world from an equity market perspective?
I still think the U.S. is going to dominate. And the reason is earnings, right? The earnings growth rates in the U.S. are still very, very solid, and they're likely to continue to be solid going forward. I also think that, look, the rest of the world, if I look towards Europe, they're going through more challenges from a structural standpoint. Even politically, they're going through some challenges right now. So it's just going to be harder for them to get the fiscal stimulus to drive the industry. And in many ways, Europe is in many ways a large cap value story, right? So it's not that large cap value is a bad sector. It's a good sector to be in. But you've also got to be very selective and diversify around that. And Europe doesn't necessarily have the growth and technology space that the U.S. does. And that's where we see a lot of the potential earnings growth to be in the U.S.
Great. So maybe moving on to the credit complex, how do you see credit working out in the next year?
So look, we don't think that there's going to be a recession in 2025. So therefore, we think default risks are going to be low. So spreads, even though they're relatively tight today, whether it's high yield or investment grade spreads, they are historically tight. we don't think there are going to be a lot of defaults. So we think that the ability to earn the coupon and the yield in these bonds today, given that yields are higher, actually represents a reasonable return that could actually compete a little bit with equity returns, right? So think about it. Like if you're getting investment grade credit yields somewhere around 5%, 5.25%, somewhere around there. And if you get a drop in yields, the Fed is expected to cut rates 2 times this year. If you get a little bit of a drop in yields, let's say you get 50 basis points decline in yields, you could get about a 7% return overall in high quality fixed income. That could rival equity returns. So it's really about how we balance fixed income and equity. And again, it's all about being selective, right? It's not so much about the passive view of fixed income, because I think the interest rate cycle is more or less moving sideways these days, so you just can't rely on buying and holding and just sitting in bonds and doing nothing. You've got to be somewhat selective and you've got to be active. But if you do that component right, then I think you can not only get the coupon, but you can also get some of the alpha. And I think that return combined could be, mid-single digits, slightly higher than mid-single digits.
Great. Well, maybe moving on to alternatives. You've talked a lot about alternatives and the value alternatives have in a portfolio from a diversification perspective. Maybe talk a little bit about how advisors and clients should be thinking about using alternatives this year.
Look, going forward, this is not going away, right? We have to figure out ways to incorporate alternatives into our asset allocation framework, and I'll tell you why. When we think about over the past 40 years, let's go from 1981 to say 2021, right? We were in a 40-year bull market in bonds. What that meant was that you had 37 out of 40 years, you had positive returns in fixed income. Your average annualized return was close to 8% if you just sat in fixed income passively. If you did a 60-40 portfolio, right? Equities returned on average about 7 in that period of time. If you did a 60-40 portfolio passive, you did pretty well, right? You had 60% of your portfolio giving you a 7% return, 40% giving you about an 8% return. Net, you tracked about 7.5% with a pretty high Sharpe ratio. Today, what structurally has changed is that the interest rate cycle is no longer just trending lower. Like I was saying earlier, it's likely to trend more or less sideways, which means that bond returns can't rely on just duration to give you that passive return. So in order to diversify your portfolio, what you're going to need to do is find a third asset class. And that third asset class is alternatives. And what alternatives does is it finds its value and its valuation from not just economic cyclical environments, but actually from deep valuation, from longer holding periods. It does have an illiquidity risk premium that's attached to it. And it is a diversifier relative to fixed income and equities. And we think that if you balance a portfolio between equities, fixed income, and alternatives, we think that you can get those high Sharpe ratio returns, and you can get those returns that are around target. Most people's target returns are around 7%, and they like to have something like that sustainable. And I think that alternatives are going to give you is going to be a key component of you achieving that return in a way that you have stable volatility.
So if you think about relative attractiveness within the alternative universe across private equity, private credit, real assets, infrastructure, where do you see the attractive investment opportunities in alternatives?
Yeah, so my first pick is going to be private equity. And the reason I say that is that if I look, I'm relatively positive on the public equity market. And if I look at private equity, its valuations are actually better than I think cheaper than what I think the public equity market valuations are. If I look at enterprise value over EBITDA, it would show that the valuations in private equity just look a little bit more attractive. I know it's gone through a couple of years where it's been a little bit challenged, but you can never time the bottom in these things. And I think that you've got to sort of pick your spot, pick your valuations and get in. Real estate I like. Real estate I like because it's a real asset in many ways. And what I think is that we are going into an environment that will have some inflation challenges. I'm not calling for very high inflation or anything like that. What I'm saying, though, is that if target inflation from the Fed was 2%, and it was hard for many years to get above 2% inflation, I think it's going to be hard to get below 2% inflation sustainably. And I think that inflation as a component of returns is going to be a bigger element. So that's one of the reasons why I like equities, because equities tend to do better in an environment where you have moderate inflation, it helps earnings and things like that. But the private markets, real assets, infrastructure, and even on the private equity side, I just think it's an environment where you're likely to have more deals, buyouts, M&A, all of these various things I think are going to create value opportunities. And it's a sector or it's a segment of the market in alternatives that has lagged. So I think if we have some confidence in the future, it could be an interesting place to be.
So it sounds overall optimistic across the board heading into 2025.
Yeah, overall optimistic. I mean, we still have an expectation that we're going to see growth levels in the U.S. around potential growth, maybe slightly above, say between 2 and 2.5%. Inflation, I think, is going to be somewhere under 3%. Relatively steady policies. And, broadly speaking, we also have to think about the politics around this as well, right? So we have a new president that's coming in, President Trump. I think of this in terms of like a trifecta of policies, and it's taxes, tariffs, and deregulation. So if we think about tariffs in general, right? So tariffs, it seems to me, are likely to be more targeted as opposed to broad-based. And if they are, to me, that's a positive, just broadly for the markets. It's less onerous than what the markets thought they were going to be. Deregulation is another component of this. This is what Trump 1.0 did. In Trump 2.0, he's going to continue to deregulate. What the deregulation effectively does is it frees up a lot of the animal spirits and also value in the market. Basically, it creates higher productivity. The government steps aside a bit, and you tend to get more economic value created through more productive means. And essentially, that overall can be a positive going forward. On taxes, tax reform, we know that in Trump 1.0, he had the Tax Cuts and Jobs Act, right? That's likely to get extended under Trump 2.0. So that in and of itself could also be a positive as well. So I think from a government perspective, and we have to remember that fiscal policy now is going to compete with monetary policy. We've lived in a world where it was always about the Fed and monetary policy and things like that. Today we have to think about fiscal policy. And taxes, tariffs, and deregulation are going to be the new policy tool that we have to think about. And so far what we're seeing is that that's likely to be a bit more business friendly.
Very cool. Jim, thank you so much for being here. Great way to kick off 2025. Whether it's bonds, equities, alternatives, and transition investments, The Beat delivers the insights and ideas that investors need to navigate any market conditions. Thanks for watching, and don't forget to subscribe to stay updated with the latest commentaries from our investment specialists. Thanks for joining.